Joe, I'll begin with you, just playing off what Liz Ann just said. Fairly richly valued valuations of the market because earnings are, in her words, not realistic. Your response?
Well, I think it's fair to say that. I think we don't know ultimately where we're going to go with earnings until we begin to hear from companies in October. And I think that's why you're in this period right now. It's almost a period of purgatory where we are beholden to the macro. I think Liz Ann's spot on in terms of oil, yields, and the dollar leading ultimately where the tape is going to go. But let's remember, there's really nowhere to hide right now in the market. You know, we keep pointing towards Apple, we keep pointing towards the NASDAQ. It's actually the Russell, which is down the most of the major indexes.
Russell's down 5% in a month, and it's the only of the three, only of the majors that's both down over 3 and 6 months as well.
Yeah, and people will tell you, trade up high in quality. Well, we look at the debt market. Investment grade is actually struggling in the last couple of days. Equal weighted strategies not performing. Look internationally, you're seeing emerging market currencies have wiped away the gains, and even dividend strategies are not working. So I think it takes me back to where we are right now, and there's absolutely a domino effect, Scott, with what's going on in Apple. And the domino effect is leading more towards what I believe is position management. I can't remember in the 16 years I've been doing this where I came on air and I said the following: the short-term chart for Intel looks better than the short-term chart for Apple. Intel's up 16% over the last 9 trading days. So I think within the market, you've got this position risk management going on. It's affecting NVIDIA, which is down significantly. It's affecting Broadcom, which is down significantly. But to the benefit within technology, and this is why I think the NASDAQ hangs in there, Meta is okay, Alphabet's okay, Microsoft, Oracle, Adobe, the software ETF, they're all okay.
So, Nicole, if you go down the list, so, Liz Ann mentions, oil is a problem, rising yields are a problem, the strong dollar is, earnings aren't realistic, nor are valuations when you put it all into the pot and you stir it up and you pull it out. Is that how you see it as well? I mean, look, the market's hung in there, too, and the market's been remarkably resilient through everything that's been thrown at it for the most part, and we've been through little fits of the like of which we're experiencing now, and we bounced right out of it in no time.
Yeah. Scott, last week you and I talked about the freight train that is mega technology heading into the end of the year and trying to make guesses around how we think about positioning into the end of the year and where that momentum comes from. And to your point, and to Liz Ann's point, when we look at Apple, when we look at the trickle-through effect, yes, elevated valuations plus a little bit of geopolitical headline noise, the thought about competition entering, a pretty heated space. Look at NVIDIA, look at Qualcomm. And then we think about these headwinds that we have. Yes, interest rates. Yes, oil. Yes, the U.S. dollar. And then also the one that we haven't mentioned yet today, which is the consumer weakening. And so the question then is there enough of a growth story in the tailwinds that are AI and productivity, and perhaps a reacceleration in manufacturing and some of these pockets like normalizing that we're seeing in healthcare? Is that enough? Is that enough to kind of look at, once the noise settles in the NASDAQ trade, the repositioning underneath to lead us to, yes, it's a broadening, we're okay through year end, or maybe it is a flight to safety into the end of the year? And I think that's to be determined. We can't make a reflexive decision today based on recency bias.